You check your bank account. The number hasn't moved in months. Meanwhile, prices keep climbing. Groceries, rent, gas. You start wondering if your money is even working for you anymore. But here's the real problem. It's not that you don't have money to invest. It's that you don't know where your money would actually grow the fastest. And in 2026, that answer has changed more than you think. Because right now, there are 10 places your money can go where it earns more than it ever could just sitting in a checking account. Some are almost risk-free. Some come with real risk attached. All of them are worth understanding because the highest yield investment for someone else might be the wrong one for you. Let's break down where the smart money is actually going this year. The principle behind yield. First, a quick decode. Yield just means how much money an investment pays you back, shown as a percentage of what you put in. A 5% yield means for every $100 you invest, you earn $5 back over a year. Simple. But here's the part most people miss. Higher yield almost always means higher risk. That's not a coincidence. It's the entire logic of investing. Nobody pays you extra for zero risk. If something offers you a huge return with no downside, that's usually a warning sign, not an opportunity. So as we go through this list, we're moving from the safest options to the riskiest ones. Keep that structure in your head. It matters more than the numbers themselves. Number 10, high yield savings accounts. Start with the simplest one. A high yield savings account is just a regular savings account that pays you a much better interest rate. In 2026, the top online banks are offering somewhere between 4.5% and 5% annual return. Compare that to the average traditional bank, which is still paying under 0.5%. That gap is enormous. $20,000 sitting in a high yield account earns you close to $1,000 a year in interest. That same $20,000 in a traditional account earns you less than $100. Same money, same risk. Wildly different outcome. This isn't where you build wealth, but it's where you should be keeping your emergency fund and any cash you'll need in the next year or two. Number 9, Treasury Bills, often called T-bills. These are short-term loans you make to the US government. You give them your money for anywhere from 4 weeks to a year, and they pay it back with interest. Because the government backing them is about as reliable as it gets, T-bills are considered one of the safest investments that still pays a real return. They're not going to make you rich, but they're a smart parking spot for money you don't want, exposed to the ups and downs of the stock market. Number 8, certificates of deposit. A certificate of deposit, or CD, works like this. You lock your money away with a bank for a set period of time in exchange for a fixed interest rate. The trade-off is simple. You give up access to your cash for months, sometimes over a year. In return, the bank locks in a rate for you that usually beats a regular savings account. Right now, some of the strongest short-term CDs are paying just over 4% for terms around 10 to 12 months. If you know you won't need that money soon, a CD can quietly outperform a savings account with almost no extra risk. Number 7, I-bonds. I-bonds are a special kind of government bond. Their return is directly tied to inflation. When prices rise faster, your I-bond pays you more. When inflation cools down, so does your return. That makes them a kind of insurance policy against your money losing value over time. There's a catch though. You can only buy $10,000 worth per person per year, and you can't touch the money for a full year after buying. Still, for a slice of your savings, I-bonds are one of the few investments specifically designed to protect your purchasing power. Number 6, TIPS. Similar idea, different structure. TIPS stands for Treasury Inflation Protected Securities. Instead of the interest rate changing with inflation, the actual value of what you invested adjusts upward as prices rise. Think of it this way. A regular bond pays you a fixed amount, and inflation quietly eats into what that money can actually buy. TIPS fight back against that. Your principal grows alongside inflation, so your return keeps its real value instead of slowly losing it. Number 5, high yield corporate bonds. Now we start climbing the risk ladder. When a company needs to borrow money, it can issue a bond. Investors lend the company money, and the company pays it back with interest. Companies with strong credit pay lower interest because lending to them feels safe. Companies with weaker credit have to offer higher interest to attract lenders because there's more risk they won't pay it back. Those are called high yield bonds. Some funds built entirely from these bonds have been paying yields close to 7% recently. That's a meaningfully higher return than a savings account. But remember the principle from earlier. That extra return exists because there's real risk the company could struggle to pay you back. Number 4, dividend stocks. Here's where a common mistake shows up. A lot of new investors assume the stock with the highest dividend yield must be the best choice. Often, it's the opposite. A dividend is a portion of a company's profit paid directly to shareholders. When a stock's price drops because the company is struggling, the dividend yield can look artificially high simply because the price fell, not because the payout grew. That's not strength. That's often a warning sign. The stronger approach is looking for companies with a long, consistent history of paying and increasing their dividends year after year. Those companies tend to be financially healthy, and their yield reflects real strength, not a stock price in trouble. Number 3, REITs. REIT stands for Real Estate Investment Trust. It lets you invest in real estate, like apartment buildings or shopping centers, without ever buying property yourself. You buy shares, and the trust pays you a portion of the rental income it collects. Some of the largest, most established real estate funds have historically paid around 4% in yield, with very low fees attached. That means you get real estate exposure and real income without ever calling a landlord or fixing a leaky faucet. Number 2, CLO ETFs. This one sounds complicated, and honestly, it kind of is. CLO stands for Collateralized Loan Obligation. It's a bundle of loans made to companies with weaker credit, packaged together and sliced into different risk levels. Until recently, this was only available to massive institutional investors. Now, regular investors can access it through ETFs, which typically pay out monthly or quarterly. The upside is a genuinely high yield. The downside is complexity and less liquidity than a typical bond fund. This is not a starting point for a new investor. It's an advanced tool for someone who already understands what they're holding. Number 1, private credit. At the very top of the risk and reward scale sits private credit. Large companies that don't qualify for traditional bank loans borrow instead from private lenders, often big financial institutions. Because the borrowing terms are harder to secure elsewhere, the interest rates involved tend to be attractive for the lender. That's you, if you're investing in this space. Private credit is known for high yields and relatively low day-to-day volatility. But it also tends to require longer commitments and less flexibility to pull your money out early. The insight most people miss. Here's the part that actually matters more than any single number on this list. The goal was never to find the single highest yield and put everything into it. The goal is knowing what each yield is compensating you for. A savings account pays you less because it's asking almost nothing of you in return. Private credit pays you more because it's asking for patience, complexity, and tolerance for risk. Neither one is better. They're built for different jobs. Your emergency fund has one job. Your long-term wealth has a different job entirely. Trying to make one investment do both is where people get into trouble. Bringing it back to your money. So think about your own situation for a second. Money you need in the next year belongs somewhere safe, like a high-yield savings account or a short-term CD. Money you won't touch for 5 or 10 years can afford to take on more risk in exchange for the chance at higher growth. That's the real decision, hiding behind every best investment list. Not which number is highest, but which risk matches your actual timeline. You checked your bank account earlier and the number hadn't moved, but now you know that's a choice, not a fact of life. Your money can be doing more. It just has to be in the right place for the right amount of time. That's not luck. That's just where you decide to put it next.